Good morning, all. Sorry for the slight delay. We had a bit of a glitch there with one of our presenters, but it looks like we've got about 30 people on the webinar now. So I think we might kick things off, and no doubt we might have a few more people join as we go. So good morning, all. Welcome to Strategem's retirement planning webinar. My name is Brett Marchant, and I'll be the MC for the session. For those that are new to Strategem, we are a locally owned and operated firm with 7 partners, 50 staff with offices in Bendigo and Melbourne. We are a leading provider of tax, accounting, wealth creation services to individual private investors, industry, small to medium-sized enterprises and share market investors. Our approach is to provide holistic, quality financial services to our clients throughout their life. Today's webinar is all about retirement, and we will explore the following topics: the reality of retirement, relying on the age pension, when you choose to retire or is retirement forced, the risk of best laid plans, building a path, and retirement planning strategies. Together with our investment partner Morningstar, we have engaged Jodie Fitzgerald, who will guide us through today's webinar and give us real insights into planning for retirement. Jodie is well qualified to talk about retirement and investment issues. Jodie is the current head of institutional portfolio management at Morningstar, along with being chair of the APAC Investment Committee. She has over 20 years experience in both technical investment and business leadership roles. Jodie joined Morningstar from Australian Unity, where she was head of investment product and strategy, where she was part of the management team that led, developed and shaped the strategy of business unit. Jodie has also held senior management positions at UBS Wealth Management, Deutsche Asset Management and Scandia. Finally, she holds a Bachelor of Economics and Finance degree with first class honours. Sitting alongside Jodie are a number of Strategem advisors, which include Daniel Nolder. Daniel started his career at Strategem 8 years ago after graduating from La Trobe University here in Bendigo, and has developed very strong relationships with his clients over the past 8 years. We've also got Sean Fletcher. Sean brings a wealth of experience to Strategem, having been a financial planner for the last 15 years. He's also our resident insurance specialist, so he helps our clients protect their wealth. And finally, myself, Brett Marchant. I've worked in the financial planning and asset management industry for the last 24 years. The last 8 years, I've been a senior financial planner at Strategem. We anticipate that today's session will run for about 45 to 60 minutes. Jodie will kick things off initially, and you'll hear from Daniel, Sean and myself later in the piece about a few retirement planning strategies that you may wish to consider. Feel free to ask questions in the Q&A box at the bottom of the screen throughout the presentation, and we'll do our best to answer those questions before we conclude. Finally, we love feedback. So following the presentation, we'll forward you a survey to complete. And if you wish to have a one-on-one chat with a financial planner at the end of this webinar at some point in the future, please make a note on the survey. Over to you, Jodie. Thanks.
Thanks, Brett, and thank you all for joining us today. Apologies, I was the aforementioned glitch. I had a bit of trouble getting into the webinar. Look, today we're going to talk about retirement planning. It's one of those things that's really easy to put off and to worry about later. The further away it is for you right now, the less relevant it actually feels. Most people actually think, well, I've been contributing to superannuation, so it'll sort itself out in the end, right? Unfortunately, life sometimes isn't that easy. And most of us have a vision of what retirement might look like, but actually to get that vision to come to fruition, you really do need to consider financial planning and how you're going to actually meet those goals in retirement. Sorry, I'll just click through these screens. So just before we head into sort of the presentation today, I just wanted to draw your attention to the fact that the information provided today is for general advice only. Your expectations in retirement and the reality of what you may face might actually vary. And what we find is typically that there are two areas where we see gaps in people's retirement. The first is an understanding of how much money you will need in retirement. Now, this will actually be different for everyone, depending on the type of lifestyle that you'd actually like to enjoy in retirement. The second thing that can happen is that people actually outlive their savings. A survey that was conducted earlier this year and released actually found that 53% of Australians were worried about outliving their savings. Now, that fear is actually understandable because we're living longer. And the question really becomes, is because we're living longer, have we actually got enough savings to account for that? The good news is that you can actually take action, and that good financial planning prior to retirement can increase the chances of you actually achieving your retirement dreams. Apologies, there seems to be a bit of a delay in my screen. So how much do you really need? That's kind of the ultimate question. Now, there's a group called ASFA, which stands for the Association of Superannuation Funds Australia, and they produce a benchmark of an annual budget needed for either a comfortable or a modest retirement. It's updated quarterly to reflect inflation, and the paper, which is publicly available on their website, provides detailed budgets of what singles, couples would need to spend in order to support their chosen lifestyle. So having a look here at the top one is for a modest lifestyle. Now, realistically, a modest lifestyle is a little bit better than the age pension, but still fairly basic levels of activity. If we use the couple as the example here, what you'll see is that an annual budget for a couple with a modest lifestyle is about $40,000 per year. You'll note to the column on the right where it says the amount required at retirement, it's only $70,000. It's low essentially because people in this bracket are basically reliant on the age pension, and they're supplementing that age pension with small amounts of savings that they've accumulated through their working life. Now, clearly, this is probably not the aspiration for most of us. The comfortable lifestyle, there on the bottom. With the comfortable lifestyle, this actually assumes that you partake in a broad range of leisure activities, recreational activities, a decent standard of living so you can afford to update your phone, you have a reasonable car, good clothes, etc., and the occasional holiday. Now, for a couple, at the time of retirement, to meet a comfortable lifestyle, you will need $640,000 at retirement. Now, it's important to note a couple of things here. Firstly, ASFA still assume that there'll be some reliance on the age pension for this lifestyle. And in the case of both budgets, it's assumed that retirees own their own home outright and that they're relatively healthy. Now, this latter part is actually quite important because health is one of the major costs that you'll incur in retirement. So ensuring that you have adequate savings to meet that is quite important. Now, realistically, these are very base level assumptions. And if you're like me, your definition of a comfortable retirement is probably quite different to ASFA's definition of a comfortable retirement. So if that's the case, then this 640,000 really should be a minimal aspiration level. So we know roughly how much we actually need, but the reality is that there's a number of things that can actually knock you off course. So what do you need to be mindful of? One thing that most people don't think about is that you may actually not be in control of when you retire. So according to a survey that was conducted by Investment Trends, nearly 50% of people retire earlier than they had planned. There are a lot of different reasons for this. Some of the reasons include health issues, involuntary redundancies, so people who are made redundant at later phases of their life and find it difficult to find re-employment. There's also a bunch of other reasons that might force you to stop work, such as needing to look after family members, etc. So while you may feel that you're on track to have an adequate amount of savings to meet that comfortable retirement standard, the reality is you may actually need a plan B. Another issue that you need to consider and be mindful of is really how you're investing your superannuation money in the years prior to retirement. This is very important, and I cannot stress this enough. That's because at this time in your life, your savings is actually at your highest. And the number of years that you actually have left to replenish those savings from working is actually at its lowest. So let's imagine that you're 2 years out from retirement, you're a couple, and as a couple, you have $1 million in superannuation. So you're completely set for a lovely retirement, traveling overseas whenever you would like. Now let's also assume that most of your superannuation is invested in shares. If the market drops by 20%, which it can do, it recently did more than that with the recent coronavirus sell-off, a 20% drop equates to a loss of $200,000. If that occurs at the time of retirement is actually planned, then what you have left, being $800,000, may be enough to fund the lifestyle that you were expecting. So at this point, you've only got a few options to replace those lost savings, none of which are likely to be palatable. The first includes deferring retirement. We saw that during the global financial crisis. People who were on track just to have a modest retirement found that their super money went backwards and they could no longer actually afford to retire. The other option is that you could be cutting expenditure, so not having those holidays that you would like to have in retirement, or relying more on the age pension. The final option is that you could actually say, well, with the money I've got left, I'm going to take on more risk in my investments to try to get a higher return. Again, not wise. So what you'll see in this chart is you'll see that there's a zone, I guess, it's called the retirement risk zone, where if you see an unexpected loss, which might be from the share market, or it could actually be a need to fund some sort of life event or emergency, that it reduces your wealth and therefore is likely to reduce the number of years for which your retirement savings will actually last. Having a good financial plan in place is really important to make sure that your portfolio, your superannuation portfolio, is invested adequately during this time to try to minimize this risk from actually occurring. Now, even if we have the issue under control of will we have enough, that problem is actually compounded by the fact that we're living longer than ever before. Now, it's great that we're living longer, but what it means is that retirement might actually be a much longer proposition than what we have actually saved for. The superannuation system in Australia, despite being close to 30 years old, it's actually still fairly young. We won't really know how successful the system is in terms of the level of savings that people are required to undertake in that system until people like me retire, because I've actually been in the system from the first day I started work. When the system was first launched back in 1992, the average life expectancy was 77.3 years. So if someone was to retire at 65, on average, they needed to fund 12.3 years worth of retirement. Now, because of medical advances, we are living a lot longer. There are studies around what's referred to as longevity, which is how much the life expectancy increases. And those studies actually reveal that life expectancy actually increases between 2 to 3 years every decade. So as the chart that I have on the screen here to the right shows you, there's actually no indication at this point in time that life expectancy is starting to plateau. This chart I've taken from a book called The 100-Year Life. It's actually a really fascinating book on how society and the way we think about retirement will need to change as we live longer. And it basically shows, using current life expectancy tables, a child born in the West today will have a 50% probability of living to 100. So in those instances, retirement will be a 35-year proposition. So the idea of simply retiring at 65 may no longer be palatable. So it's a good, if you like reading those sorts of books, I'd certainly suggest getting your hands on that one. But if we think this through, and if we think about, well, the current projections of life expectancy, if you're 55 years old and looking to retire at 65, you will need to fund 21 years of retirement. That's getting close to almost double the average retirement length when superannuation system first started. So the reality is those minimum contribution rates, they just may not simply be enough. So what happens if you actually find that you're running short on cash? Either you haven't saved enough for your life expectancy, or simply haven't put enough away on top of your standard superannuation contributions? Well, you may need to work for longer than you actually planned. You may need to rely more on the age pension than what you were hoping for. And in fact, according to the ABS, today, around 50% of the average retiree's income actually comes from the pension. Or the other option is that you'll need to compromise your lifestyle in retirement. Now, planning is very useful in ensuring that you actually, when you get to retirement, that you actually have enough. But once you're actually in retirement, the challenges that you face are actually different. So the planning cycle doesn't necessarily stop there. The retirement challenge, I guess, is actually really easy to express, a little bit more difficult to solve for. So on the left-hand side, you'll see that when you retire, you have 4 potential sources of cash flow or income in retirement. It'll be a combination of the age pension, whatever you've saved in your superannuation, any additional savings outside of super, or any sort of investments that you might have, so a investment property, etc. With these sources of income, you then need to work out how to actually use those sources of income for your consumption needs. So basically, retirement's about cash flow management. I've actually categorized the cash flow needs into 5 distinct categories, and for a particular reason. So first, we've got basic consumption. We need to eat, we need to make sure the lights turn on, we need to make sure our house is well maintained. The second is lifestyle. Now, lifestyle is a swing factor. If you haven't saved enough, it is one of the things that can actually be reduced. So you don't have the holidays, you don't upgrade your car as often as you'd like, etc. There's then healthcare cost and aged care costs, and finally the bequests. These last 3 I've separated out. The reason being is that, particularly with regards to healthcare costs and aged care costs, these tend to be some of the largest cash flows that you will need to plan for in retirement. However, they are unknown in terms of their timing and in terms of their quantum. You don't know how healthy you will be in retirement, nor do you know if or when you may actually require aged care assistance. When we have a look, as I mentioned before, some of the biggest costs are those healthcare and aged care costs. If we go back to the ASFA numbers, now remembering that ASFA actually makes the assumption that you're healthy in retirement, ASFA is assuming that a couple with a comfortable lifestyle actually spend close to $12,000 a year on healthcare needs. So if you don't meet that healthy categorization that they have, you can expect them to be a lot larger. From an aged care perspective, for those 65 years and older, what we find is about half of men require some sort of aged care needs, where it's about 2/3 of women, mainly because women outlive men. Now, if you have actually had anybody in your life, whether it be grandparents or parents, that you've actually had to help navigate the aged care system, you will probably note that it looks something like this. It's terrible. It's a complete web. It's often referred to as the aged care maze. It is complex. It is difficult to navigate. One of the things I want to iterate here is that, again, you might be sitting there thinking, oh, aged care, that'll be my kid's problem, right? When I'm old and so forth. However, the government actually has a philosophy, a policy in place now of aging in place. The reality is most people won't necessarily end up in an aged care facility, but they will require home care. So as people age, they need services to come into their home to assist with the maintenance of the house, to help with chores around the house like mowing or cleaning, or even to assist with other chores like shopping. So all of this can be included in aged care packages. Now, navigating this system does require certain expertise. And again, this is where financial planning can actually assist you on this journey. So the big question is, we can see all these obstacles and all these challenges that you may or may not have thought about. How do we actually increase the confidence that you'll have a comfortable retirement? And in a moment, I'll hand back to the Strategem team to discuss the services that they offer from a pre and post-retirement perspective. But basically, The one thing I'd like to reiterate here is that ultimately pre-retirement planning really comes down to setting goals. What are you aiming for? To be successful, you need to know what retirement looks like for you. You need to know when you would roughly like to retire. If you're actually going to retire full time. Some people don't want to retire full time. They want to transition into retirement with some part-time work. What are your lifestyle goals? Once you have an understanding of that, you then will know how much money you actually need, and you can work backwards from there. You know, we discussed the ASFA standard, and we discussed the sources of where you might actually receive some of your income from in retirement. But the reality is there is no magic number. The number provided by ASFA is very generic. It assumes certain health-related and home issues. It also assumes certain ways of spending. You will need to sit down with an advisor and get an understanding of what your goals are and therefore how you would meet those with a combination of these 4 different ways of actually generating cash flow in retirement. So I will pause there and hand back to the Strategem team to discuss their services.
Thanks, Jody. Thanks for highlighting some really important issues when it comes to retirement planning. And yeah, we've got a few more slides that Daniel, Sean and myself will have a look at now. Just a few, I guess, retirement strategies that you can employ in the coming years to help boost that retirement nest egg. But as Jody said before, in my 24 years of being a financial planner, the one thing just keeps coming back, and that is planning. You've got to plan for the future. And I often say to clients that, look, it's never too late. So even if you're wanting to retire in the next couple of years or 5 years, that there is still time to improve your retirement nest egg. But at that point, it has to be very disciplined, and you have to have the right strategies in place to really maximise that retirement nest egg. Because at the end of the day, the more money that you have walking into retirement, the more flexibility you have as well. So those modest and comfortable guidelines or benchmarks are quite interesting, because another conversation that I have when I talk to pre-retirees about, okay, what does the future look like? How much do you need to live on now? And what does the future look like in retirement? How much do you think you need? A lot of my clients say, well, we don't really know, Brett. We kind of know what we spend now, but it's difficult for us to look into the future and say, okay, well, this is what we're going to need at retirement. So I always come back to that those ASFA standards, the modest and the comfortable. And I do talk about, okay, if you want a modest income, this is kind of what you need. But if you want a comfortable lifestyle, this is what you need. And it's interesting, some of the feedback or comments that I do get. I mean, some clients look at that comfortable lifestyle and go, you know what, we need a bit more than that. And that's fine, because everyone's lifestyle or needs in retirement are different. And then other people look at that comfortable lifestyle and say, look, I don't need anywhere near that. So everyone's different. Everyone has different needs and objectives in retirement. But again, coming back to the overall point, it's a really good idea to start planning as early as you can. And as Jody mentioned, people that sort of entered the workforce around 92 are going to have the benefit of being in this superannuation system for their entire working life. But there's many people out there that haven't enjoyed that. There's a lot of people that think the minimum that the employers put in at the moment, the 9.5% of income, is not going to be sufficient as well, and that is due to increase in the coming years. But I think one of the chief architects of the system, Paul Keating, has always said that people should be putting in sort of 12 to 15% of their income into superannuation each year to make sure that they have a really nice nest egg at retirement. So look, we might just cover off on the next few slides here. I think, Daniel, you're up first, aren't you, talking about a couple of strategies that we've been talking to clients about for many years now.
Yeah, thanks, Brett. Yeah, so essentially the first one I just wanted to briefly touch on is around salary sacrificing, and I guess the idea of salary sacrificing is to take away some of your pre-tax salary and essentially contribute that money into super. So I guess as an example, if you're on a marginal tax rate of 30 cents in the dollar, basically we can put some money into super. It does get taxed at 15% on the way in, but essentially, firstly, you get the tax saving of the difference between that 30 cents tax rate and the 15% tax rate going into super. So it reduces your taxable income outside, and it's also building up your super towards retirement as well. So that's a great way to build up your nest egg. There is a cap on that, which is $25,000 per year, and that $25,000 limit is inclusive of any super or employment contributions as well. So we do have to be careful around not breaching that cap, because that obviously causes some issues. But yeah, salary sacrifices, it's a great way to reduce your taxable income, but also increase super. The other that's a pre-tax contribution. The other form of contribution is what's called an after-tax contribution, or a non-concessional contribution. So that's basically money you're putting into super you've already paid tax on. So you can't claim a tax deduction. It's not getting taxed on the way into super, and essentially you can put up to $100,000 per year in as a non-concessional contribution. There is some allowances where you can use what's called a bring forward rule, where essentially you can take the 2 years after the current financial year, so you can essentially put 3 years worth of contributions in one hit, so up to 300,000. There is some rules around that, and once you've triggered that bring forward rule, once you've maxed out that 300,000, you can't make contributions for 3 financial years. And there is some age limits and that sort of thing around that as well. The government has just recently increased the age that you can make non-concessional contributions without meeting a work test. So now someone that's 55 or 56 can do that. So you don't need to meet the work test until you turn 67. And so if we can just flick to the next slide, Jody, I think Brett will talk about some spouse contributions.
Yeah, thanks, Daniel. And look, I should have added that the strategies that we're talking about are very much centered around superannuation. So as Jody mentioned in one of her slides, superannuation tends to be, well, pretty much for a lot of people, tends to be the core component of their retirement nest egg. But that said, there's other investments such as share portfolios or investment properties or term deposit or cash accounts that contribute to income and capital in retirement. But certainly the strategies that we're talking about today are certainly centered around superannuation, because look, superannuation is pretty much the most tax-effective investment vehicle that most people have access to. The tax on superannuations while in accumulation phase is a maximum of 15%. And then when you're able to convert it to pension phase, you pay no tax on the earnings and no capital gains tax. And when you're over 60 years of age, you don't pay any tax to get money out of superannuation. So for those people over 60 years of age in pension phase, it's 100% tax-free environment, which is a great position going into retirement. But unfortunately, one of the things that probably everyone is aware of with the superannuation system is it's forever changing. So that's one thing that you can sort of probably bank on in the coming years, that the government will probably step in at some point and change the rules. They've done that very much for as long as I've been in this business. The last major changes came through on the 1st of July 2017, where they made some changes to the contribution caps. As Daniel just mentioned, the non-concessional cap is $100,000 per annum now, or you can trigger the bring forward provision and do $300,000 over 3 years. And the concessional contribution, so that's your personal deductible contribution or your salary sacrifice, and your SG contributions at 25. I remember, when was it? I think it was back in 2006. It was the concessional cap was about $100,000 at that point, and then the global financial crisis kicked in, late 2007, and the Prime Minister of the day, Kevin Rudd, had to make some hard decisions. So the cap was brought down to $50,000, and then it came down to $35,000, and now it's at 25. So that's just an indication of that they do change the rules every so often. So look, just picking up on the slide that's in front of you now, look, spouse contributions and downsizer contributions. So I'll start with the spouse contribution. So a spouse contribution is effectively a member contribution made by a person directly to their spouse's superannuation account, and it's known as a spouse contribution. So at the time of the spouse contribution, the receiving spouse must be under age 67, or if age 67 to 74, must have satisfied the work test or the work test exemption. The individual making the spouse contribution can be any age and does not need to satisfy that work test that Daniel mentioned. And spouse contributions may allow the contributing spouse to claim a tax offset of up to $540 if the maximum $3,000 contribution is made. But to take advantage of that full tax offset, the income threshold to qualify for that full tax offset is $37,000. So just a couple of other points to note in terms of spouse contributions. They count towards the receiving spouse's non-concessional contribution cap, and they do not qualify for the receiving spouse's government co-contribution, and they are not tax deductible to either the receiving or the contributing spouse. Downsizer contribution. So this one's a fairly new one. It came in on the 1st of July 2018, so only a couple of years ago now. So this contribution allows individuals aged 65 and over to be able to contribute an amount equal to or part of the sale proceeds from the sale of their main residence of up to $300,000 each into superannuation. So the downsizer contribution can be made regardless of other contribution caps and restrictions that might apply to making voluntary contributions. So it's essentially, well, the rules are it's not a non-concessional contribution and it doesn't count towards any concessional contribution caps. So if you do have a large superannuation balance, and once you have a total super balance of more than $1.6 million, you're usually not able, well, you're not able to make any non-concessional contributions going forward, but downsizer contributions can still be made if an individual has a total super balance of over $1.6 million. Also with the downsizer contribution, it forms part of the tax-free component of the individual's accumulation superannuation account. But there's also a few eligibility rules when it comes to making this contribution. So there is quite a list here. So I'll capture a few. But as I said, the contributor is age 65 and over at the time of the contribution. There's no upper age limit. The contract of sale on the main property, the principal property, has to be exchanged on or after the 1st of July 18. The contribution is also an amount equal to or part of the sales proceeds, but no more than $300,000 per person. And also another eligibility box that you have to tick is the residence has to have been owned by the individual, their spouse or a former spouse for 10 years or more prior to the sale. So this is regardless of whether the ownership interest was held solely by joint tenants or tenants in common. And also another thing that you need to make sure about this one is that the contribution must be made to a compliant superannuation fund within 90 days of the change of ownership. Now, if for whatever reason you can't make that time frame, you can always apply to the Commissioner of Tax for an exemption. Also, another requirement when it comes to downsizer contributions is you have to lodge a form with the superannuation either before or at the time of making the downsizer contribution. So the super fund needs to know exactly what type of contribution it is. I did this recently for a client. They owned a property out at Longley, and they sold that property and decided to move down to Bairnsdale to be closer to family. So yeah, got a call from this client not too long ago actually, and said, look, he wanted to put in $200,000 into his super fund, taking advantage of this downsizer contribution opportunity. So it's something that we're starting to deal with more and more, but it's probably something that we're going to see in the future as well, I think.
Just need to get myself off mute. Hi guys, thanks for joining us today. It's been really good. So I'll just touch on the last one, which is the transition to retirement strategy, and I'll briefly just give an overview. The transition to retirement strategy measure allows people to have reached their preservation age to access the superannuation benefits without having to retire or actually leave their job. So as Jodie outlined today in the presentation, sometimes you just don't get to choose when you retire, or you might need to reduce some working hours due to ill parents, or you might even just want to look after the grandkids. And the beauty about also this strategy is that you might just want to give retirement a bit of give it a bit of airtime, give it a go as far as just reducing those hours. So this is a great way to access your super, but also still keeping the workforce and to keep your mind active, I suppose, getting out and about. So it's a good way just to ease into retirement without compromising your lifestyle. So you can still make contributions into the superannuation in the accumulation phase. You'll also be able to receive tax-free pension payments as well, only if you're over 60. And it's just a great way, as Daniel was saying before, around salary sacrifice. This is one way to increase your salary sacrifices into super, but also get a bit of that pension as well. So it's a really good strategy to use, albeit the government changed some rules in 2017. It's not as shiny as it used to be, but it's still a great strategy for us. So that one is the last one that we've got for our webinar. So I'll probably hand you back to Brett just to round out Strategem and some of our services.
Thanks, Fletch. So yeah, look, as I said before, the key here is to really, I guess, take charge of your current situation, because again, everyone's different. But yeah, planning is the key here. So if today's presentation has got you thinking about taking action to prepare for retirement, we certainly welcome the opportunity to discuss these issues and further issues with you. As I mentioned, after the webinar, we'll be sending out a survey, and that survey will provide you with an opportunity to say, yes, I do want to have a further chat to one of the Strategem advisors. Another area that our clients get a lot of value out of is the financial modelling that we do for them as well. So I've just recently engaged a new client. So they're still, he's probably still about 5 years, probably 5 to 7 years away from retirement. And he's paid off his debt now, his mortgage, debt-free. He's got adult children who are no longer living there. So it's just mum and dad left in the household, and both are working, earning good income, but they probably haven't been as focused on their retirement nest egg as they probably should have over the last 10 or 15 years. But now is the time to really take charge of the situation. So they've come to me recently to say, look, we need your help in terms of navigating what the next sort of 5 to 7 years might look like. But also what we want to see is what does retirement look like for us going forward? So a lot of our retirement plans or retirement advice factors in financial modelling. So the financial modelling really, I guess, for these clients that I'm using as an example, is really a two-step process. It's the process between now and retirement, which might be in 5 and 7 years' time. So what do these two individuals need to be doing to really take charge of their retirement nest egg and really take it to the next level? And look, at the moment they've got pretty good super balances as they are. But with a couple of fine-tuning points, they can certainly take it to the next level. So that's what we're going to be providing advice on initially. What do you need to be doing in the lead up to retirement? But also what happens at retirement? So with our financial modelling, we have to we have to make some assumptions, and this date of retirement has to be penciled in. So at some point I will activate, okay, this is the date that you're going to retire, and this is what your future looks like. And what we can do is we can predict the future via fairly sophisticated modeling to say, okay, well, if your super funds return 7% per annum, if you draw down $60,000 from your retirement nest egg, if you pull out $20,000 on day one to update your car and $50,000 in 2 years' time to buy a caravan, this is what the future could look like for you. So a lot of our clients get real value out of not only coming to us for immediate advice, but also having a look at what does it look like in the future if we actually put all this advice into place. And where we start with this financial modelling is to really say, okay, well, if you make no change to your current circumstances, this is the road that you're currently on, and this is what it's probably going to look like at retirement, but also at old age. And as Jody mentioned, we're all living longer now, so we usually model about 5 years beyond life expectancy. For a male, that's typically sort of late 80s, and for a female, that's typically early 90s. So we want to make sure that we're getting effectively across the life expectancy line. Yeah, we can certainly help people, I guess, navigate what it might look like in the future. So I might have a look at some questions which have been posed. So thank you for those that have sent through a couple of questions. And look, if there's more questions, please put them in the Q&A box down the bottom, and we can answer them as a team. So look, the first question that I've got here is someone's just asked the question about the tax-free threshold, which is $18,200, and marginal tax rates. And the question really relates to, okay, well, at what point does it become uneconomical or does not make sense making personal contributions to superannuation? So as Daniel mentioned before, when you make a deductible contribution or an SG contribution or a salary sacrifice contribution, the super fund takes 15% contributions tax when the contribution hits the super fund, and then passes it on to the tax department. So for low income earners, sometimes it doesn't make sense to make pre-tax contributions. The question I've heard many a time is, Brett, should I salary sacrifice 100% of my income? And the answer to that is no, you shouldn't, because again, it gets to the point where the marginal tax rate, 19%, kicks in at $37,000, but with some tax offsets and tax rebates, it's more like around the $27,000 mark, that it doesn't make sense for you to make deductible contributions to super. But again, everyone's situation is a little bit different. So best to actually have a chat to someone and just be quite clear on the complete picture there. But yeah, certainly somewhere between the 27,000 mark and the 37 mark is probably, you're not going to see any benefit or not too much benefit of making deductible contributions. Another question that we've been asked here is, given the low interest rate environment, should I pay off my debt or contribute more to super? Fletch, I might get you to answer this one.
Thanks, Brett. Yeah, this one's a really tricky one to go, well, we are in a really low interest rate environment, mid-twos, 3%. And then, typically with the shares, they're paying 5 or 6. But as Jody outlined, we did have a bit of a sell-off, when COVID hit. So this just generally comes back to how much should we got to go on our debt? Is it 20 grand, or is it 100,000, or is it 200? It comes down to really your circumstances. But and then it's just trying to find that balance between, do we salary sacrifice, or do we clear some non-deductible debt? So, it's a real fine balance to find. There's no correct answer. What it comes back to is what you're really comfortable with. So that might be a bit of both, or it might be, hey, let's just clear the debt because you want it cleared. And, that's everyone's goal in life, to be debt-free and then move into retirement. But, at Strategem, we'll work with you to find the best financial benefit for you. So hopefully I've answered it without answering it. Thanks, Brett.
No worries. Another one has come through too. can you please explain the difference between accumulation phase and pension phase? Daniel, I might get you to answer that one.
Yep, no worries, Brett. Yeah, so basically, accumulation phase is generally, you know, if you're still working or you're under the age of being able to access super. It's basically accumulation is basically when you, as it says, accumulating super. I guess the main differences between accumulation and pension is accumulation. You're still getting taxed on your earnings within super, so any earnings are taxed at 15%. As opposed to once you've reached the age or you've retired and basically commute your super into pension phase, then the earnings are tax free. Once you do commence an account-based pension, then you do need to take a minimum amount each year as well. So that's that's another thing that you need to keep in mind. You do need to meet the minimum requirements each year. So the main differences is just the tax component, which, as Brett touched on earlier, just that 15% tax on earnings, and also the minimum drawdown for pension phase super.
Yeah, and another question that's sitting there too is what's the difference between a transition to retirement pension and a retirement pension? So I might just answer this one here. So Fletch mentioned transition to retirement. So that's all about accessing your superannuation in the form of a pension upon turning your preservation age. So the way the transition to retirement pensions work is that you, like a retirement pension, you have to take a minimum, which has been reduced last financial year and this financial year because of COVID-19. So if you're under 65 years of age, the minimum you have to take usually is 4% of the account balance, which is worked out on the 1st of July each year. But under COVID-19 conditions, it's now 2%. And that percentage just increases over time as you get older. So once you turn 65, it moves to 5% and just increases as you get older and older. And the transition to retirement strategy was certainly a strategy which we employed for a lot of people in the past because of the tax benefit of going to transition to retirement phase. It was exactly the same as retirement pension phase, but unfortunately a few years ago the government changed the rules on that. But again, coming back to it, still might make sense for individuals to commence a transition to retirement strategy because it will give you some income, which will allow you to top up your superannuation contributions or maybe even pay down some debt. Whereas a retirement pension is effectively you've met a condition of release. You've basically said, look, I'm retired. I'm not going to be working any further. So you can get your superannuation into retirement phase or pension phase, where you pay no tax on the earnings and no capital gains tax. And as I mentioned before, if you're over 60 years of age, the current rule is that you don't pay any tax to get money out of superannuation as well. Another question just around age pension as well. So I might answer this one as well. Talk to me about age pension. I've heard there's an assets test and an incomes test. Yep, there certainly is. So to get an age pension, you not only have to tick a few eligibility boxes, but in terms of you've got to achieve age pension age. But once you achieve that age, you can then approach Centrelink and say, okay, am I eligible for an age pension? So a lot of our clients do get a part pension. And it all comes down to what are your assets and what's your income. So you've got to pass an assets test. So as a couple, you fail the assets test if your assets are in excess of around $850,000, and that's excluding your principal place of residence. So that's really just looking at your superannuation, shares, investment property, motor vehicle, contents, boats, caravans, those sort of assets. So you've got to pass both tests, but as I said, if you're going to fail the assets test as a couple, it has to be in excess of about $850,000. The income test is more generous, so we don't actually see too many people fail the income test because you can earn around $70,000 a year before you fail the income test. But coming back to Jody, a number of Jody's slides there, certainly age pension entitlement from Centrelink is something that a lot of our clients do get. So it effectively supplements your income in retirement. But again, coming back to what I said in terms of the holistic portfolio or income source through retirement is usually a drawdown from your superannuation. Maybe some share dividends from a personal share portfolio you've got, and maybe some age pension entitlement as well. So that kind of rounds out the questions that I've got. If anyone's got any other further questions after this webinar, please feel free just to send them through, and we'll respond to them. Yeah, that's sort of covered all the questions that I've got at the moment, I think. Hang on, let me just. No, sorry, I've got a couple more down the line here. So another question here is, what are the best investment options for super in COVID times and the future it holds? All right, Fletch, I might bounce this one onto you.
Oh, give me the curly one, Brett. Well, this is an interesting time, COVID. Been in the industry 16 years, so we've been through, some major events. The global financial crisis was one that really comes to light, and then this one. So, and we're also in a low interest rate environment. So, what it's about is making sure our asset allocation is still in line with our risk profile. I think that's the key message around this, is to go, how many shares do we hold, international property, just making sure that is still in line with that is always the key around what's the best investment option. So, they're all great investment options. Yeah, we did see it come down. However, we have seen it bounce back up a little bit as well. So, sticking to the strategy and the asset allocation is key to the future and, your future returns in reaching retirement. So I hope that answers it to a certain point.
Yeah, and look, Fletch, I might just add to that. Look, it's Strategem. Before we invest one single dollar for someone, we need to identify what their risk profile is. So we want to ensure that the advice that we're providing is appropriate to your particular circumstances. So part of the fact-finding process is to not only gather the information that we need to give you holistic advice, but also to really drill down on what your comfort level is in terms of investing. It's challenging times when stock markets fall in a big way like they have recently. So between the 21st of February and the 23rd of March, the Australian stock market dropped by about 36%, and the same thing happened on the US stock market as well. But since the 23rd of March, we've had a real good rebound. We're still around 15% down from where we are from the peak, but things are starting to rebuild. But again, coming back to how do we invest money and what do we recommend to clients? We start with that risk profile. We want to make sure that no matter what's going on in investment markets, your comfort level is where it needs to be. That said, some people try and time the market. So they try and, take positions in certain asset classes at various times of the market. My philosophy is to stay fairly true to your investment profile or risk profile, no matter what's going on, because trying to time the market, coming out of the market and then back in the market is very challenging. And there's actually good research out there that actually suggests that it's time in the market rather than time in the market that actually generates good long-term returns. Another question here in terms of how does Strategem operate from a cost perspective? So we're fee-for-service advisors. So what that effectively means is if you do come and see one of the Strategem advisors, we'll spend a bit of time with you initially just to understand your circumstances, and then we'll engage you to do the work that you want us to do. So usually, the first 30 minutes or so is free. It's just a bit of a no obligation meeting just to understand what you're trying to achieve. But if we need to do any substantial work beyond that, we will charge on a fee-for-service basis. And again, everyone's situation is a little bit different. So it's very difficult for me to actually say, okay, well, a typical financial plan costs X, because everyone's situation is different. But yeah, for the individual that's asking the question about that, yep, we can certainly help you out. We don't always go to the full financial plan. It might be just a general conversation about your circumstances, and as I said, depending on how much time we have to devote to it. Any personal advice, by law, we have to put it all in writing, so that takes a bit of time. So look, I'm just conscious of time. We've got a couple more minutes to go. So I might wrap things up, and well, from my perspective, I think it's been a really good webinar. And remember, planning is the key, and we're here to help you with that. So look, can I firstly thank everyone that's participated in today's webinar. We really appreciate your time. The last time we delivered a retirement seminar was actually in-house in our training room at 35 Mundy Street. So this has been very different given the current situation that we're all dealing with. So I think it's gone pretty well. Also, a special thanks to the individuals that made today happen. So Erica and Jody at Morningstar, thank you so much. And Megan and Sean at Strategem that did a lot of the behind the scenes work to get this webinar and presentation up and running as well. So well done. So once again, thank you all for participating, and look out for that email containing the survey. As I said before, we love feedback. And we're certainly looking to do more webinars like this in the future. So if you've got any ideas about topics that you'd like discussed, whether that's personal insurance or estate planning or aged care or share markets, whatever, let us know, and we'll work towards running more webinars in the future. So once again, thanks for your time and have a great day.
Thanks, guys.
Thank you.